The topic that came to my mind, which I don't think we've really delved into before, is I think people probably hear about investing in startups. So
Hmm.
you and I
Yeah.
know some about that. I figured, that's something that comes up as people just, I don't know. I seem to read about it all the time, just in any kind of investing news about researching startups and ventures and tech startups and just all that kind of stuff. So I figured that should give us a good amount of conversation around that. We'll start out pretty basic and maybe get a little bit more advanced into what we know or what we've been experienced in with different things and what comes to mind, and see if we can give some helpful information that would apply to people that are doing it currently or think about doing it or think about one day maybe down the road they'll do it. So in general, we talk about investing in terms of you put your money somewhere hoping it'll grow, whatever, different purposes. Most people know of investing. They think of Roth IRAs or stocks or mutual funds or all these different words, which, yes, basically means putting your money somewhere to grow for a purpose. And when we talk about investing in startups or small companies, most of the things that 99% of the public is invested in are publicly traded companies or funds through their IRAs or their 401ks or brokerage accounts or whatever. But they're all typically publicly traded. And that's something we've kind of gotten into a little bit in previous episodes, or if you watch any of the didactic minute videos from on YouTube or Facebook, we talk about kind of basics of investing, and that would be explained in there. So reference that. But today we're going to talk about investing in businesses that are very small businesses, sometimes brand new businesses, and they're not publicly traded. So you can't go on a stock exchange and get them. And so they are technically a private transaction between you and this company getting shares of a company. And there's a lot of different ways and forms that this can take. And typically your money's going to be locked up for a certain amount of time. And you're hoping for drastic growth compared to, let's say you put into mutual funds or S&P 500 index fund or whatever. You're hoping for pretty steady rate of return, maybe some slight ups and downs, but long-term shooting for maybe 10% a year growth, give or take. And so that's predictable. What's not predictable is when you invest in a small startup company, because it's really a gamble. It could go either way. The startup company has no history. It's got a new idea sometimes, but you're putting a certain amount of money, and usually there's minimums, 50,000, 100,000, whatever. So this is not necessarily geared towards residents typically, but a lot of attending physicians that we work with get to the point where they've got this cash and they're maxing out other things, and they say, what are some other creative things that I can invest in? And there's tax benefits that we won't necessarily get into, but you'll see these called private placements or Reg D, are these private transactions. A lot of times you do need to be an accredited investor, so making 200,000 a year plus or net worth of $1 million or more. Those are the SEC's guidelines for what is an accredited investor that can then invest in these private investments. They assume that you are knowledgeable, experienced, and savvy enough with that kind of money to both A, have the capacity to risk that, and B, you probably know a little bit about money given you've reached that point. Now, we're talking to doctors here who, just because they're wealthy doesn't mean they know a lot about money, let's be honest, which is why FinancialMD is here. But so that's not necessarily an all-encompassing, hey, you make decent money, you must know something about investing. No. So when you hear things like a tech startup or you see an IPO is basically a startup that got a lot of investments over the years and is finally deciding to go public. And again, that's another conversation. This is before these companies go public and you get in kind of on the early stage, or you'll see things like a seed round or a Series A, these different terms that involve what phase of the business is it getting this money. When these investors invest, they get shares in the company, get equity, so that when eventually it gets bought out for $1 billion by Google or Amazon, then everybody who invested early wins big. So that's the gist of the concept. Trevor, what am I
Yeah, let
missing?
me spin with for anybody who that didn't make sense to, because John's kind of giving you like some different perspectives and different parts, different terminology. You're kind of
Yes.
like adding terminology throughout. So if that didn't all make sense to somebody and they were just following, like, oh yeah, I know what that is. Oh, I know what that is. Like, and you're about investing in a company, don't. I mean, that's not financial advice because I'm not an advisor. It's definitely not individual advice, but
Mm-hmm.
in general, you want to understand, the market that you're investing in. You want to understand the market for a startup for sure. You want to have some sort of kind of advantage to know whether something is BS or not.
Yeah.
Good ideas fail all the time in the marketplace. Like good ideas that are turned into businesses fail like all the time.
Yeah.
So you don't want to invest in an idea so much as you want to invest in people and the application of a good idea. So the execution and the business of the idea is what you want to invest in.
Mm-hmm.
So my favorite book on the topic, or maybe like the best book on running a startup, and if you're trying to be the startup guy, would probably be Venture Deals, which is kind of like the Bible for raising any sort of capital from like multi-million-dollar companies all the way down to smaller raises. It just gives you a good understanding of what all that means. Like, what are stock? What is common stock? What is preferred stock? How do you want to structure a deal? That's why it's called Venture Deals. It's a good book. It's written by a couple like kind of Silicon Valley insider guys that wanted to educate themselves and other people on the system. They wrote a book, and it's sort of just it's almost like a how-to manual. So it gets into the nitty-gritty. But that's a solid one for people looking to do raises. For people investing, I haven't done that, but I know, we know some people that do that. That's like their thing.
Yeah.
They pull in people like me essentially.
Yeah.
So I'm hearing about things. I haven't invested. I'm hearing about things, and yeah, you want to big picture things like how big can a company get? If you're putting in 10 grand and it's going to give you 10%, and then the company is going to be worth $100,000. So you got 10 grand for 10%.
Yep.
If you're just even amount, then what's that company at 100 grand today? What's it going to be worth later when it's like successful? Because you're getting in really early. So if it's going to $1 million, you have like a potential 10x return on your money. Now 10x sounds incredible, and those are actually pretty rare.
Yeah.
Even though you hear people doing like a 50 bagger or 100 bagger or something like that, but a 10 bagger is still like ridiculous. You do that a few times with a decent amount of capital and you're going to crush it. But if you're doing it with 10,000, and you get a 10x, it's only 100,000. Like that's great. But like, I think a lot of people think they're going to get in on something, they're going to get rich, and you have to kind of look at numbers. If you can't put numbers to it, then you're not investing. You're just gambling.
Yeah.
I think a lot of people end up gambling and they're like, ooh, it's cool. I invested in a company. Don't be cool. Be smart. Like being cool, do other things that are cool, like get a new set of golf clubs or something.
Yeah. Trying to be cool is how us guys get into trouble throughout most of our life.
Yeah. Yeah. That's true in general. But like,
Yeah.
you want to be cool, like buy a car and buy a $40,000 Corvette, and at least your downside is $40,000.
Yeah.
Plus repairs and maintenance. But like at least it's capped, right?
Yeah.
But if you put the money in, you may end up investing more. You could get dragged through the mud. You got your emotions. You could lose a friendship if it's a friend. So when I hear about startups, I think high returns if successful, low likelihood of success. There should be a limited upside that they can articulate to you. Long list of risks, and then the emotional toll, like of that.
So, and you're not typically involved in this company. It's not like you're all of a sudden,
you're just giving money,
partner,
right?
Yeah. So you've got to be willing to, this is money that you can part with and be ready for it to be gone forever, right?
Mm-hmm.
That's the worst case scenario.
Yeah.
But totally likely.
Right.
Or, also be ready to just invest it, and not, like you said, the emotional volatility that goes into it too. Like, don't be following this company every day,
Yeah.
seeing how they're doing or checking up. Like,
Right.
we don't have that kind of stress and time. So, if this is something you wanted to get into at some point, just know, yeah, it's something. Hey, I've got this completely
Right.
discretionary money that I can lose. It's $5,000, $10,000, whatever that might be for you. I'm going to put it here, and if it grows, great. I'm not going to pay attention. I might get updates every month or quarter, whatever.
Mm-hmm. Yeah, if you're just the investor, that's true. If you end up being a big investor, or if you're taking an active role, then it does get more interesting. You can do a lot of things. You can try to
Yeah.
get a board.
Yep.
If you want to have control, you got to get a board seat. If you want to have like decision making that's required to be considered by the rest of the group, you got to really have some things in a contract. And then you're
Yep.
like advisor and or board seat, and like there's a lot of components. But if you're like just giving your time, that's another way people, especially doctors, can invest in a company. You can become an
Mhm.
advisor. That's nice because it just costs you your time, and
Yeah.
potentially then you got the emotional component. You have your own expectations.
Mm-hmm.
Expectations is like a huge part of this. It's like, what am I going to get out of it? How guaranteed is it? The
Mm-hmm.
answer is usually not much, and there's no guarantee.
Yeah.
That's like business. So doctors aren't used to getting into business. Oftentimes they're like, I went to medical school and then I became a doctor, and then now I get the salary and they always pay it to me. And
Yep.
the only variability is how many RVUs or how much surgery I perform or patients I see, and then maybe I get more or less. But that's not how everything else works out. It's usually uncertainty, and doctors often tend to go into medicine because they like certainty.
Yeah.
Even though there's uncertainty in medicine, there's certainty and safety in the job. So
Right.
I think there can be there's a lot of doctors who have gotten ripped off, right? Just
Mm-hmm.
in general. And especially I think in investing, not so much with financial advisors, to be honest. I think it's a lot more like people doing companies and doing raises or things that sound like a sure thing.
Yeah.
I don't know about you, but when I hear about something that starts to sound like a sure thing, my first response is skepticism.
Yeah.
If I like it and I'm interested and it still sounds too good to be true, then my second step is research, thorough vetting and investigation about something.
Yep.
We're not even talking about startups. I mean, again, the risk level, the likelihood of failure goes up dramatically. I'm just talking about like stocks that I'm interested in or something, or cryptocurrency or whatever. Right. I should say Bitcoin because I don't really endorse crypto in general. But
well, that is good. That's a lot of people talk about. Oh, I heard about this crypto. I heard about this one or this one. You know what I mean? And that is getting as prevalent as any type of random.
It is. It's terrifying. Every time I hear it, I'm like, R.I.P. R.I.P.
Yeah.
But I put in that, just be ready to never ever see it to go on.
So if you're looking for tips and tricks on that, I mean, that's inventing a new cryptocurrency is just so easy to do that these things are popping up all the time. Oh, I just heard about it today. I must get in early because it's going to grow and I'll make money. Like, no, for all these ones you've heard that have grown incredibly. I mean, how many dozens or hundreds have not?
Oh yeah.
So it's kind of like that IPO conversation of, ooh, if I get an IPO today, it's gonna have to go up, right? Not typically, honestly.
Yeah, most go down 30 to 40%.
Yep.
Before they end up, and then now everything goes up, but before they go back up, they usually go down for a while.
That is not financial analysis right there.
That's the
Everything
sarcasm.
goes up. Everything goes up. Invest in whatever you want.
Well, the Fed tends to buy everything right now, so
yeah.
It's a weird time
today.
It's a weird time to be about specific investments because it's hard to not be doing well right now.
Well, and everyone, it relates to our conversation.
In a bull market.
Mm-hmm. Yeah. And the problem with that is if you just started investing in the last 5 years, then that's what you know, and that's going to influence your bias towards how you feel about the future of the market, that it just always goes up. We've had such a good, this must be how
Yeah.
it is, you know,
Housing,
every
housing,
housing for sure. That's, you know,
real
you and I
estate.
have been alive long enough to see 2008 and 9 and 10. And I probably told this story before, but in 2012, I bought a foreclosure because they were everywhere and stuff was undervalued. And so I was just lucky enough to be looking for a house for me and my family. We bought a 4-bedroom in Lansing area for $150,000, and then sold it for $300,000 8 years later. But that's not something you can expect. And if you buy a house this year or last year, you can probably expect that that's possibly going to go down in value in the next 5 to 10 years. So, you know, things cycle, and just understand what goes up does often come down.
Mhm.
And if we're talking about basic long-term retirement planning, you know, we base that on things typically long-term do go up, but there are ups and downs along the way. But when we talk about startups and talk about cryptos, like any of these things like that, that can just pop up and say, hey, invest in me. That doesn't mean anything. And when you're investing in IPOs, say something just is going public, you think, great, I'm getting early. You're not getting in early. There's tens or hundreds of thousands of other investors, whether it was the employees that got some shares, the founders, the early investors, like they've all got shares that they're going public because they're ready to cash out. And not everything, but a good chunk, like they get together and say, okay, I'm ready to become a millionaire, or like, let's go public. So that means the public gets to invest in it. They typically are selling their shares now. That's what
Mhm.
you're buying, is their shares at a
Mhm.
very high price.
Right. And
So
somebody bought it for you to be able to buy it. So,
yeah. So that's what, like, the early winners already got in. Now that's not to say, like, a lot of IPOs we see like start out high and spark and then come down and then maybe gradually go up if it's truly a good company, but just be ready for that. And investing in a startup early on with venture capital is even more so like that. So
mhm.
um
In terms of one other huge factor, this is in general, this is a nice general point.
mhm,
For investing in general, you want to have a specific time horizon of like what you're doing with this investment. So
mhm,
you want to look at, if I'm getting in this startup, and it applies to all, but startup is nice. How long when am I looking at getting my money back? What's my return on investment, the time to my return on investment? That's an important factor too when you're putting your money in, because if you're putting it in 10,000 and you just have the gambling attitude, well, it's gone and we'll see what I get someday. But an
mhm,
investor, it goes, I'm putting in 10 grand, and that's whatever percentage of my net worth, and or maybe 100 grand, and I expect to get such and such a return, and I think the chances of that happening are 25%. So when you start to invest multiple things at that level, you're putting in 100 grand, you think 25% chance of return, you're just estimating. People who are really good at estimating can do this across the board. So then you can essentially, that when you give that away, it's worth $25,000 to you.
yeah,
Like, you do the math on that for the risk level of like, okay, I just sunk 75 grand in the hole on this. I think I might get 25 back,
yeah,
uh, maybe nothing. And then back to the time horizon, you want to know how long, like, okay, how long until I get it back? And, or how long do I want to be willing to let go of that $100,000? So I want, you know, this portion of my net worth to keep cycling back to me in 5 years so I can make different decisions. Or, you know, this is a 1 year play and I just want to like stake you, and then you're going to give it back to me as soon as you have it.
mhm,
Or it's 10 years or 20 years. And it's like, I just want to hold this forever. Like, people who buy gold, they don't really ever plan on selling it. They just want to have some percentage of their net worth in uh, a less fungible asset.
yeah, it's a hedge, right?
Yeah, it's a hedge, right? So they have different purposes and they have different time horizons. But startups tend to be high risk, high reward. And I was, or I'm currently doing a raise for like a Bitcoin mining thing right now. And one of the things I found is people want like a 5x or higher return in 3 years, 3 to 5 years. Those are like the startup minded folks. And I don't think there's anything wrong with that. But when I learned that, I was like, you guys are going to lose all your money. Like, not literally, but you better have some winners, because that's those are hard to find. 5Xers are pretty hard to find in general, especially in the 3 to 5 year range. You got to be talking software, and what I'm doing is hardware, right? So you're buying a lot of expensive machinery, so it has a different multiple. But then in your portfolio, maybe that goes into the more conservative range. Now, Bitcoin sounds speculative and not conservative, so it's hard to find an investor who thinks it's as conservative as the returns are, if that makes sense.
Right.
I'm probably getting a little off track there, but I found that really interesting because I'm like, I see this as a conservative bet. You can reliably get this, but it's not a startup return, but it kind of requires the emotional or mental tolerance of a startup, because to the guys with money, it's expensive to start. To most of the average, say like boomer kind of population.
Yeah.
I use that affectionately, not as a criticism. I know how that goes, but they have a different time horizon. It's part of the reason. They're like, I kind of want to do a 5X in 3 years because I want to retire in 5.
Yeah.
So a lot of these guys are like, oh, they're doctors late in their career and they kind of want to accelerate their retirement. And they still want it to feel low risk. I think startups feel low risk because, oh, that's a familiar concept. Oh, these young guns, they've got a great idea. They're going to triple my money. And that's not, I don't know.
Yeah, why do you think people think that is safer than it is? And I don't necessarily understand that.
Love story. People are persuaded by narratives.
That's
why people get into these random other cryptos, because they sound cool. Oh, we're going to solve that problem with the blockchain. And, oh, I read something about the blockchain. I think I understand that. It sounds cool when I talk about it at my weekly coffee meeting, my friends. It's like,
well, because they're a relative expert compared to the people they hang out with, right? So they makes them feel smarter than they are. It's this expert bias or self-confidence bias, we call it.
It's called the Dunning-Kruger effect.
Yeah.
The less you know about something, the more you feel like you know more than you know. That's the short version of it. It's basically like you go in and you take a test and you're like, ooh, I nailed that. And it comes back and you got a D minus, 68% or something. Whoa, I didn't know what I didn't know.
Yeah.
So
yeah,
that's common, I would bet, in investments and startups, especially if you get lucky with one.
Do you think it has to do with just the psychology of maybe optimism, of you kind of convince yourself that?
Totally.
Yeah.
Gambling, right?
Yeah.
Do people have a good understanding of their odds when they place a bet on a sports team?
I bet it's a very similar place in the brain, right?
It was for me when I, my story. Like I got into the crypto trading stuff in 2017 at the peak of the like an idiot, and it taught me some lessons. But you kind of have to learn them on your own. Like
It's true.
I've talked to people who are like getting into it right now. It's most things are at all-time highs.
Yeah.
In general, not just in cryptocurrencies.
Yeah.
So if you think you know more than the guys who are selling at all-time highs, what are the chances that you're going to do better? I mean,
yep, exactly. And it's not like you walk around. Yeah, and for most of us, 99.9% of us, by the time we hear about it, it's too late.
Yeah. That's a good rule of thumb. It's kind of like it's a misnomer, but if you've heard about it, it's too late. Like
unless you work at the company, it's not inside information. Okay, it's public unless you work at the company, and then it is inside information and it's illegal and you can't invest in it anyway. So there's no winners here.
Yeah. So conservative investing over the long term is much wiser. The trick right now is you have to put your money in something or else you're like rapidly losing value from inflation. So I just think today that like the US loves like the CPI, right? They pull out basically everything that inflates and then they don't include it in the inflation metric. CPI doesn't include like housing, doesn't include cars, doesn't include a number of food items. Yeah. There's a good website on it. I'll see if I can think of it, but there's been 3 versions of CPI since the 80s, and they just kept taking out things that were inflating.
Mm-hmm.
Germany doesn't do that, and their year-over-year inflation as of, I think, a month ago was 11 point something percent.
Oh
That's
my
a much
gosh.
more honest metric than
Yeah.
ours, which is 6.
Well, and
6
it's like we can all feel these things, and if they put out these crap numbers like inflation's normal this year, like there's no way. Like you're looking at, I mean, freaking price of
Right.
steak is going up, and obviously gas and houses and all these other things that are obvious. But
Right.
yeah, that's another story for another time.
It's one of those things where it's hard for me to understand how people can't be sure that they're being lied to.
Yeah.
We are all being lied to, and the narrative is being controlled, including the math behind the reality, right?
Sure.
So that's not conspiratorial. You can just go and read about the changes to the CPI and what's included. It's a basket of goods is the term.
Yeah.
And they're not representative of living costs. And CPI is designed to tell us the inflation of living costs.
Yeah.
So that's a direct manipulation
No, and
on
housing is the biggest one, and they're not including that. It's crazy to me.
Mm-hmm. So anywho, it was nice to hear like an apples to apples.
Yeah, no, that's good to know. I didn't know Germany's was that way. That's a huge help and makes me think I'm not so crazy. I'm like, I feel like prices are going up everywhere, but the government says they're not.
If you're feeling like for me, it's one of my like spidey sense things is if I feel like I'm crazy,
yeah,
I'm like, okay, maybe I'm crazy, but let me look into it first, right?
Yeah.
Because that I feel like I'm crazy usually also is like, it's probably fine. It's either like it's probably fine or you should be a little worried. That's kind of like a little red flag in your mind. Look into it, and your mind detects those things because it's trying to protect you.
Yeah. No, there's some truth to that for sure. We are built with a certain sense, we're created with some good there are things that set us apart, but even animals, like I feel like have some of that, you know what I mean? Like somehow dogs just inherently know when somebody's a good guy or a bad guy.
Right. That's I thought you were going to say that because I was thinking the exact same thing. There's just something there of like, it's a smart thing. Yeah.
It's and I would say, how can residents and doctors apply this kind of knowledge? Like whenever you're dealing with an advisor or an insurance agent or something like that, and there's like you're starting to be like, this seems great, but this can't be right, and again, not that it can't be, but do some homework, talk to somebody. As I mean, heck, anyone listening to this, you guys can shoot us questions if you're like, hey, I was told about this deal or this product or whatever, what do you think? And we'd be happy to debunk stuff.
For doctors, there's just like so much you can add for companies and startups and things like that. Like I can speak from personal experience that it tends to just be networking, making friends in areas and talking to lots of people and like listening to podcasts and just like throwing caution to the wind a little bit in terms of just reaching out and chatting with somebody you're curious.
True.
I had a buddy in residency. He reached out to this guy who was developing like an AI algorithm for something he found interesting with retinal imaging. And he just like reached out to the guy, and then he ended up doing an internship there for a year, like kind of created a little mini like internship dream job for himself.
Yeah.
I have been able to work with some people and some companies that I've really enjoyed just from reaching out or even doing a little bit of free work or like hopping on some calls, answer some questions. That it's specialty knowledge. It doesn't cost me a thing, other than opportunity cost of my time. If I wanted to try to bill for it, you can do a little bit of that, or, just, I started out just doing stuff for free and giving away just a lot of my time. And then you build some connections and friends, and it's fun if you enjoy it. And that's a good form of work. And
absolutely.
And, so just network and have fun with it. And then you can learn about a company too. Like if you're looking at a startup, in your knowledge base, you can tell if it's a waste of your time, it's a waste of your money. So get in there and see how you like spending your time on it, and then maybe invest from there.
Yeah,
I don't know,
100%.
But just bumbling around and trying some things, wasting your time is like the perfect way to find out you don't want to waste your money.
Yep. Yeah, I think that's good. And that's how a lot of good things happen. And we find opportunities and, like you said, opportunities that don't create a lot of risk because you've invested the time and the knowledge, and good things don't happen overnight. I'm sorry. They just take time.
Correct. And
And
there's one good deal.
yeah.
FOMOing into a job, FOMOing into FOMO meaning fear of missing out,
Mm-hmm.
FOMO to an investment or a stock or a crypto or whatever, not it's just a false understanding of the reality of the decision of do I invest or not. It's a
Absolutely.
biased mental space.
Yep.
So you step away from that, it's
Mm-hmm.
tough. And then if the price goes up, that's okay.
Mm-hmm.
Prices are going to go up in other things too. You have to miss out on things. Good investors miss out on things all the time. And they get into the right stock and then they sell on the way up, and it keeps going up after they sell.
Yep.
You can call that missing out on profits or something. But if their time horizon was, I need that cash or I want that cash for something else, they're not missing out on anything.
Yes,
They're
that's good.
with their written plan.
And I tell
So
people about that all the time that talk to me about
yeah,
stocks or my buddies. And I'm like, oh,
right.
I wish I would have stayed in. Like, you cannot beat yourself up over that or you're going to lose,
And
except that that's going to be a part of it.
sold, you sold because you were afraid and you sold at a loss and then it bounced back. Well, examine your ability to trade or
Mm-hmm.
invest, whatever. And I mean,
Yeah.
trading really means a specific shorter time horizon. People are terrible at trading.
Yeah.
Statistically, it's like 99.9% of people, I think it's 1 in 1,000 will be a profitable trader or something like that. It's
Really?
extremely unlikely. Yeah. So I guess that would be,
Yeah. Good to know.
that would be accurate.
Yeah.
So, yeah.
All right. No, that was good. Yeah, I think as always, we came up with some good stuff. I would be curious. Let's do a part 2 of this at some point and have Ruben on here from Washington Avenue Ventures, and I think he'd
I
be
was
able to.
thinking when we first started talking about it, I'm like, man, this is the guy.
Yeah.
And I feel like I gave more of a con argument and he will give much more pro, which is perfect. That'll be a good combo.
That'll be good. Yeah, the cons of startup investing, and then episode 2, the pros of it. So, yeah, that'll be good. All right,
cool.
super. Well, anything else you want to add, Trevor?
No, that was great. Appreciate your time.
Okay, so reminder to you guys, subscribe and share this. This is how we get the knowledge and good info out. If you like stuff you've heard, please share with your colleagues and friends and buddies and family. Join the Financial MD community on Facebook. Look it up and get in on there. That's where we have continued conversations from these episodes and articles are shared. Any of our other social media is going to be out there. Instagram, TikTok, Facebook is where we're putting out new stuff in a hurry. And then, shoot us a message if a question came up. If you'd like us to speak to your residency program about any of our basic financial topics, we do that as well. You can message us about that. And for those of you in the Detroit area, we've got our first graduating resident dinner of the season on December 15th in Royal Oak. So invitations will go out soon, but get on the website or shoot us an email if you want to know more about that. It's been fun. Again, this is John Salitro with my colleague, Dr. Trevor Smith. It's been great. We'll see you guys next time.
Thanks, John.